and thank you for joining us for Paradigm Wealth Advisory's presentation entitled To Infinity and Beyond. My name is Ryan Grady. I'm an investment advisor representative here at Paradigm. With me tonight is Dave Cheney, our Chief Investment Officer. And tonight we're going to talk about To Infinity and Beyond, right? We have Buzz Lightyear here, our faithful sidekick who's going to help guide us on our journey tonight. And we want to talk about three things this evening with you. So first of all, we're going to talk about where we are in the market cycle right now. Where exactly, we're going to take about a 300,000 foot view, look back and just see where we are exactly. Second, we're going to look about how we got here. What was the rocket fuel that propelled us and propelled these markets way up into space where we are today? And then third, what will it look like upon re-entry? What is it going to look like when things come back down to earth? So with that being said, I'm going to pass it on to Dave here to take us through the first part of tonight's presentation.
Thank you, Ryan. So starting with that 300,000 foot view of the markets, we'd like to give you some numbers that indicate where we are in the state of the economy and the financial markets. So 3.9%, the current rate of unemployment in the US. We lost 22 million jobs through the COVID pandemic, have gained 23 million jobs since then to put payrolls above where they were pre-COVID. 5.6%, current pace of GDP growth. Strong continued recovery from that COVID pandemic, especially considering the 2 to 3% average GDP growth that we've seen over the last decade. 2.7 trillion current fiscal deficit in the US. We've seen spending on infrastructure, on unemployment assistance, direct stimulus to businesses. Current level of fiscal deficit is the second highest since World War II. Coincidentally, the highest was in 2021. And 4.7 trillion, the amount of additional monetary policy stimulus that we've seen since the start of the COVID pandemic. So if we combine all of those together, we've seen continued economic recovery. We've seen federal stimulus in the form of monetary policy and fiscal spending. Those two things combined have pushed the rate of inflation from 1.4% to 7%. The highest inflation rate that we've seen in the last 40 years, has also led to equity market valuations that have reached all-time highs.
So that's interesting, Dave. It sounds like, if I'm understanding this correctly, despite a strengthening economy clearly indicated by the unemployment numbers, our GDP numbers, there's still continued stimulus being pumped into the system. The very thing that's supposed to help us grow those numbers, which clearly look pretty good, we're still seeing that stimulus being pumped in the system. Is that right?
That's right, and it's interesting that stimulus has benefited tech more than the rest of the market. The chart here shows tech as a percent of the S&P 500. Tech currently represents almost 48% of the index as a whole, double what it was just 5 years ago. And to put that into perspective, back in the peak of the dot-com crisis in '99, tech represented about 35% of the S&P 500. That's also been concentrated in the top 5 names of the market. If we think about Facebook, Netflix, Google, Apple, Amazon, those 5 stocks alone represent 23% of the S&P 500, just down from where they were last year, but still above that dot-com 1999 level high. We've also seen valuation show up in other areas of the market. This chart looks at the valuation of tech stocks in the blue relative to the market as a whole in the orange. While the rest of the market is trading at valuation levels similar to where it was pre-COVID, it's really been tech that's driven the valuation of the market much higher. Retail investors are also all into this market. This chart shows the average equity allocation of retail investors. Currently at 51%, is back to the levels that we saw back in 1999. Coincidentally, historically, this hasn't been good news for future returns. This chart shows that equity allocation in the blue line and also shows the next 10-year returns in the market in the orange bar below that blue line.
So that's interesting, Dave, because this is something I think a lot of us see anecdotally, right? We talk about retail investors and we see this phenomena of FOMO, fear of missing out. So you talk to your neighbor and they're talking about stocks. You talk to your parents, they're talking about stocks nowadays. You go online and social media and you hear about some 19-year-old who just made millions in his mom's basement investing in GameStop and AME. So we hear about this all the time, and it's hard to not think, well, then I want to get caught up in it. But it looks like what you're showing us here is, if history is any indicator, what we've seen is when this amount of people are diving headfirst into the equity market, it can be signs of, dare I say it, a bubble, and certainly can impact future returns, right?
Especially starting from a long-term time perspective. Hard to time the top of the market, but looking at the next 10 years from points in time where investors are all in and valuations are excessive, history tells us that average returns over the next 10 years are relatively low. Interestingly, we're showing here in the orange box previous peaks in that equity allocation of households. Both of those periods coincided with a pretty steep market pullback. Late 60s and late 90s both saw the market pull back about 40% shortly thereafter. So we've also seen fundamentals disassociate from the price of the market. This chart shows the corporate profits, which are the fundamental drivers of equity returns over the long term, relative to the price of the index in the blue. Since the pre-COVID, corporate profits have grown 25%. The price of the index has doubled that growth, growing 52%. The current delta, the gap between the price of the market and the underlying fundamentals, those corporate earnings, is the widest on record. We've also seen that dislocation show up in other areas of the market. To your point about some of the Reddit and meme stocks, the AMC, the GameStop, but also in areas of the market like Bitcoin, like SPACs. We're showing here the Goldman Sachs Non-Profitable Technology Index, which is an index of technology stocks that have not presented $1 of net income over the last 12 months, yet have been richly rewarded by investors over the last year.
That's interesting. I love that second to last chart that talks about the disconnect in the fundamentals, right? What I took from that chart is, companies show earnings here, you usually pay something equivalent that makes sense to own a share, a part of that company. Well, right now companies are showing earnings here and you're paying a pretty steep premium to own those companies, right? Very, very interesting indeed. And that term disconnect from fundamentals should be eye-opening if you're an investor for sure. I love this quote you see in front of you now. When the whole world is running towards a cliff, he who is running in the opposite direction appears to have lost his mind. We're kind of seeing that here in the market today again, right? You're out with your golf buddies, you're talking to friends, and it just seems like everybody is an expert in the equity market especially, right? Everybody's talking about the stock market and everybody has the next great investment idea. And everybody is running, as we talked about in those previous charts, head first into this market. So to be disciplined, to be prudent at these times can make you sound crazy, right? So when everybody's running off that cliff and you're running in the opposite direction, perhaps you look like the crazy one, but maybe that's not in fact the case. So now let's go to our second part of our presentation. What is the rocket fuel? What is it that launched us 300,000 feet into space? So Dave, take it from there.
Thanks, Ryan. This is the Buzz Lightyear part of the presentation. So to start, we'd like to start with a gentleman named John Maynard Keynes. John Maynard Keynes was a British economist who, during the Great Depression in the 1930s, argued that the government should take a more active role in the booms and the busts of the economic cycle. Keynes argued that during times of economic bust, the government should support demand. The government should lower taxes. It should invest in infrastructure projects. It should lower interest rates. It should do whatever it can to help people spend money so the economy recovers. Keynes argued that that help, that stimulus, should moderate as the economy recovers and inflation starts to run hot. As the economy then starts to overheat and inflation really picks up, Keynes argued that the government should then take the opposite action and take action to constrain growth and constrain inflation. So if we fast forward to the 70s, the Fed formalized their activist role in the economy with their dual mandate. The Fed's dual mandate, first and foremost, is price stability, which they defined as a 2% annual rate of inflation. It's also maximum employment, which the Fed defines as the rate of unemployment that doesn't lead to runaway inflation. So let's take a look at where we are in terms of fiscal and monetary stimulus. Fiscal stimulus, so this is the deficit that the government uses to promote that demand, is at its highest level since World War II. Monetary policy, so the Fed has lowered its short-term interest rates to 0%, has also increased the size of its balance sheet. So it's injected cash into banks' balance sheets in the hope that banks would in turn lend that money out to businesses, to consumers, and to keep borrowing costs low in an effort to further promote demand. That level of stimulus during the 07-08 crisis was about $1.3 trillion. What we've seen since the start of the COVID crisis is $4.7 trillion of stimulus, 3 times what we saw throughout the whole 07-08 crisis. That stimulus has led to both higher realized inflation of about 7% over the last year, and higher inflation expectations. We're looking here at inflation expectations over the next 1 year and over the next 5 years, both at their highest level in decades. This chart illustrates that level of accommodation. The bottom of this chart illustrates points in time where interest rates are set below the pace of GDP growth. So the government wants to do that when they want to promote growth, promote inflation. The top half of this chart represents when interest rates are set above the pace of GDP growth. Government does this when they want to do the opposite, when they want to control inflation, control growth. So back in the 70s, this very accommodative point in time led to significant inflation over the next 10 years. We remember inflation and interest rates in the teens back in the 70s, and Paul Volcker, the then chairman of the Fed, coming in the 80s and radically increasing short-term interest rates and subsequently sending the economy into a recession. Where are we today? We're significantly more accommodative than they were back in the 70s. Other impacts from inflation and from stimulus that we're seeing in the economy: wage growth. We're seeing wage growth at over 4% for the first time in over 2 decades. Equity market valuations have reached extreme levels. And corporate margins are also at their highest levels since the Great Depression.
All right, so Dave, you talk a lot about, I heard you use the word accommodative a lot, accommodating, and when we're talking about the Fed, it reminds me of an analogy of the punch bowl analogy. And the Fed's job is to be the chaperone at the party, right? So perhaps maybe the party needs a little livening up, so you bring out a punch bowl for everyone to enjoy. And as everyone partakes in the punch bowl and things start to, again, liven up, it then becomes the job of the chaperone, in this case the Fed, to go ahead and start removing that punch bowl, taking that away. And it doesn't appear that they've done that despite this party raging pretty good. So very, very interesting indeed. I love this quote we have up here. Again, another great quote. "Some debts are fun when you are acquiring them, but none are fun when you set about retiring them." Right? The numbers are quite staggering when we talk about a national debt of $29 trillion, right? We talk about non-financial corporations in the loan market, $11 trillion of debt. Households across the United States, $15 trillion in debt. That is a lot of debt spread across our country, and the bill's gonna have to get paid, right? There's gonna have to be some ramifications for that at some point, right? We're gonna take a look now about what does it look like coming back down to earth, right? We talked about being 300,000 feet into space. We talked about the rocket fuel that propelled us in there. How is it going to look when we come back down to Earth? I think about the movie Apollo 13 with Tom Hanks. Great movie. If you've never seen it, make sure you go out and do that. The oxygen tank blows up and they have this very dramatic and true story, re-entry back into space, right? Ed Harris is at the control. His character is guiding them in to a safe entry. Well, how are we going to do that? How are we going to go about navigating this safe return, hopefully back to fundamentals within the market? So before I pass it back to Dave, I just want to take a quick look and go over tapering, right? You guys have heard that term probably more in the past year than you've heard in your entire life. What is exactly happening when we say tapering? The Fed is going to begin their tapering. So let's take a quick look at this timeline here on the screen. So back in March of 2020, the Fed began buying treasuries at a rate of $120 billion per month. And that was needed, right? I mean, we can all remember back then when this pandemic first hit, people were losing their jobs, businesses were closing down. We certainly needed the help, and they swooped in and they did just that. Fast forward to December of 2021, that bond buying program has continued in the tune of $90 billion. So they slightly lowered it down to $90 billion a month, but kept injecting that stimulus into the system. Well, now we've seen in March of 2022, they're going to go ahead and discontinue that bond buying program and begin a series of rate hikes. Now, certainly this has to have some impact on the market. So let's take a look. I'm going to pass it back to Dave to explain what that's going to look like.
Thanks, Ryan. I think key point to me there is we've seen really strong economic recovery from COVID, but the Fed is only now talking about reducing the speed of their accommodation, not yet talking about actually removing that accommodation. So if we think back to what the Fed's dual mandate is, if we recall it's price stability and unemployment, let's take a look at where we are relative to those two metrics. If we start with unemployment, we're currently at 3.9% unemployment. The average level of unemployment when the Fed first hikes interest rates is 5.7%. So we've clearly surpassed their goal on unemployment. The second mandate of the Fed is price stability. So if we think where we are in terms of inflation, the average rate of inflation at which the Fed first starts hiking is 2%. We're currently at a 7% rate of inflation. So if we go back to the last 3 hiking cycles and take a look where we are economically relative to those metrics, in 94, we saw unemployment of 6.6% and inflation of 2.5% when the Fed started hiking. In 2004, we saw unemployment of 5.4% and inflation of 2.5% when the Fed first hiked. In 16, we saw unemployment of 5% and inflation of only 1% when the Fed first hiked. So putting that into perspective, the current 7% inflation and 3.9% unemployment, the risk here is not that the Fed moves too quickly, the risk is the Fed moves too slowly, given they're already well behind where they normally are in this hiking cycle. So the risk to that outlook is COVID. We have currently seen a spike in COVID cases. Yet, the rate of fatalities is significantly below where it was in previous COVID spikes. That chart on the right explains why. The chart from the CDC examines the number of people who have been both vaccinated and already infected, or the number of people that have just been infected. The total of that is about 90% of the US population. So, while we certainly expect to see continued issues around COVID, our expectation is that the lessening severity of those cases will not lead to another economic shutdown like it did back in early 2020. So, next we want to take a look at what rising interest rates might do to the markets. This chart shows the relationship between interest rates and valuations. When interest rates are low, valuations are typically very high. As those interest rates begin to rise, valuations fall from those levels. We're currently at a point where we've seen very low interest rates and very high levels of valuation. We expect as the Fed begins their rate hiking cycle and market interest rates rise, the overall market valuation will be challenged.
So Dave, it sounds like, going by that chart, We've talked about being in a low, you just said it, we're in a low interest rate environment. Valuations are to the moon, as we talked about. I just went over tapering, how we're the first of a series of rate hikes are coming. It sounds very doom and gloom right now. Is there anywhere in this market where there's opportunities, or anywhere to seek out a chance to make any money in this market then?
Absolutely. I think to us, this is the most important time to be really disciplined in the type of assets that we own. So there are 3 winners in a rising interest rate environment that will show, and 1 loser. The first winner is value stocks. We talked earlier in the presentation about how tech has really benefited from low rates and from accommodation. Value stocks haven't received that same lift, and the current differential between growth and value is at its widest level in history. As interest rates begin to rise, we believe value stocks will benefit from that relative to growth. US versus non-US stocks. Interestingly, US versus international tends to go in 7 to 10 year periods, where in one period the US outperforms, then in the next period international outperforms for about 7 to 10 years. We've been in a very long and a very steep cycle of US outperformance, but we know that the US market is very tech oriented. So rising inflation, rising interest rates, we expect that to benefit non-US stocks versus US stocks. And thirdly, looking outside the stock bond paradigm, commodities. Interestingly, commodities were the best performing asset class last year as inflation jumped from 1% to 7%. We expect that we're early in that cycle as commodities relative to the price of financial assets, stocks, is still very low. And as economic growth stabilizes and inflation continues, we expect commodities to be a prime beneficiary of that. And one loser in a rising rate environment. So this chart shows the NASDAQ, the index of tech stocks, relative to the size of the Fed balance sheet, the amount of stimulus that the Fed has pumped into the system. Hard to argue that tech hasn't strongly benefited from this level of stimulus. As we finally reach that inflection point, and the Fed goes from tapering to rising interest rates and reducing the size of the balance sheet, we expect that to be a significant headwind for those tech stocks.
All right, thank you, Dave. So really good stuff there. What we heard? We heard that it can start to sound a little bit doom and gloom, but it's not. There are opportunities in this market. We talked about value. We talked about international over US. We talked about commodities, right? Prepare for turbulence. Yes, indeed. We just saw the worst January in the history of the market just this past month. So we know it's going to be a little bit volatile. It's going to be turbulent as we, number 3, come back down to earth from this market. And the key there is to have a financial plan. Do not overcorrect. Be disciplined, especially now more than ever. Right, Dave? So big recap overall. We looked at 300,000 feet, looked back down to earth, right? Buzz Lightyear helped us determine what was the fuel, the rocket fuel that propelled us into space, right? That's stimulus money. And then number 3, the re-entry, right? That Apollo 13 re-entry back into space. We want you all to know these are the things we are doing proactively on your behalf. So if you ever have any questions, please don't hesitate to reach out. On behalf of Dave and everyone here at Paradigm, thank you so much for joining us. Stay tuned for more to come. We'll see you soon, guys.